Good evening, everyone, and welcome to this Market Insight webinar. I am Niranjan. With me today, our Chief Investment Officer, Mr. Vetri Subramaniam, and along with him, our Head of Equity, Mr. Ajay Tyagi. Lately, in India, India's young investors are focused on wealth creation and therefore are joining the investing bandwagon at an early age to secure their financial well-being. And we bring some of the most relevant topics which we believe are key for your wealth creation journey. And with that backdrop today, I think there are a lot many things for you on the plate. Keep a tab on that. And without further ado, I now hand over to Vetri Subramaniam for his initial remarks. And over to you, sir.
Good evening, Niranjan. Thank you for that introduction. And thank you to everybody who's joining us on the webinar today or watching it on YouTube, where we host it. And obviously, it's been a pretty exciting month. When we spoke last month, this was well before the elections concluded, well before the election results came out. And, in a way, it's good that we are doing this call after the election results. So I thought what we could also do this time is just spend a little time thinking about what is the, underlying foundation which has been laid for the economy over the last 10 years. And how do we think about how all of this may evolve over the next 5 years? Now, market outcomes are not linked to who is government. Market outcomes are not linked to what is the policies. Eventually, market outcomes over long periods are linked to what do the businesses earn. And eventually, the returns that we earn in the stock market are nothing but the returns which are being generated by the underlying businesses. These two cannot be divergent for long periods of time, but without doubt, government policy and supportive government policies create an enabling environment for companies to thrive and to be able to create value for shareholders. So today, what I'm going to do through the first few slides is essentially talk about what is underpinning the economy over the last decade and what we think might stay the same or change. And then finally, we'll move straight into a sort of summary of what we think are the best options for investors today in light of our overall view on macro and also on valuations. So if I think back over the last 10 years, what has really been, I would say, the lasting contribution of the Prime Minister Modi's government over the last 10 years, I would say that it has essentially been macroeconomic stability. Remember, in 2013, India was considered one of the fragile five when the US Federal Reserve decided to hike rates. There was very famously at that point of time a reaction in global bond markets known as the taper tantrum, and India came under a lot of pressure during that period in terms of its large current account deficit, and there was also a large slide in the currency value. I would say the underlying pillars which were put in place at that point of time and have been implemented over the last 10 years by this government, I would essentially point to three. I didn't want to make a laundry list of long things, so I just wanted to focus on three issues. One, I would say, is fiscal discipline. This government, through the last 10 years, has been very disciplined in terms of fiscal trajectory and the nature of fiscal spending. Of course, due to the pandemic, there was a spike in the deficit that was unavoidable. But still, I would say even their response to the pandemic was quite measured. It was not indiscriminate. And that is something which has helped the economy because we can see the damage caused by indiscriminate fiscal policy and indiscriminately loose monetary policy, which has happened in certain other parts of the world. The second thing which I would give as sort of a lasting contribution of this government has been that inflation targeting has been in place since 2016. Of course, inflation targeting is something which has built up as part of the consensus policy mix over many years, going back well before that. But this government has demonstrated its role that it has to play in ensuring inflation stays within the target range. So it is not just the MPC, which is determining the interest rate policy trying to target inflation. But Government of India has made several interventions when we look at even the last 3 or 4 years to try and ensure that inflation stays in the target range. What do I mean by that? You can look at interventions that they did. For example, after the Russia-Ukraine crisis, they did not allow fuel prices to rise. The oil companies absorbed it. And when fuel prices came down, the oil companies were allowed to sort of recoup those losses. So they provided a little bit of a shock absorber. Similarly, when fertilizer prices spiked, the government absorbed it in that subsidy so that there was no pass-through impact into food prices and into food inflation. Simultaneously, what they also did is that they did not allow exports of most agricultural produce. Now, you could argue that this may have actually hampered the farmers' ability to get a better income for their produce, but equally, this was their contribution towards making sure that inflation stayed in the target range. So not only is the contribution one of inflation targeting through the Monetary Policy Committee, which sets interest rates in India based on the inflation target, but equally government has played a very significant role in using administrative tools which are available to it to try and control the level of prices. The third element of this government, particularly in recent times, in the last 5 years, it has been more about a supply side focus. Now, when we talk about economics, we talk about supply side focus or a demand side focus. Supply side focus, and these are the list of some of the things that they've tried to do, is where you really try to promote and support those who drive the business environment, who make new investments, and also those who try and create the new jobs, the new manufacturing capacity, and you try and drive the economy from a supply side perspective. So when you look at things like the corporate tax rate cut, lower tax rate for new investments, which was also done in 2019. This is even pre-pandemic. This is a very classic supply side measure. Similarly, the production linked incentive, which has taken steam since 2020, is a very specific incentive given to companies saying, if you're able to produce and ramp up your production, we are providing a subsidy so that you are able to overcome lack of scale and lack of supply chains being fully integrated. Similarly, the provision of credit lines and support for small businesses is a very classical supply side measure. One of the measures of this government, which I think deserves more credit than it has got, was the Emergency Credit Link Guarantee Scheme during the pandemic in 2020, because it provided nearly 2 lakh crores of credit-linked lending to medium and small enterprises. But in effect, this was backstopping 12 lakh crores because the multiple was almost 6 times. So 12 lakh crores of credit was getting backstopped by this provision of 2 lakh crores, where the government said, if something goes wrong, I will bear the risk. And eventually, very marginal amounts of risk passed to the government. But providing this line of credit allowed the wheels of the economy to continue turning in the post-pandemic period. Also, new labor codes were announced in 2020, 2021, not fully implemented, but, again, this is a classic supply side measure. Then, of course, there's also Startup India, ease of doing business, many more, but I just wanted to give you a broad picture that the thought process of this government has been more about supply side focus rather than demand side measures. Typical demand side measures are things like cutting the GST, cutting income tax, because those are the kind of things which directly put money into people's wallets. It could include things like subsidies or transfer payments. But this government's focus has been more towards the supply side, not that they have not done anything on the demand side, but really the focus is more on the supply side. So in the next few slides, let's quickly run through some of the data. What you can see here is that the fiscal deficit stayed pretty much steady. And then in 2020 and 21, because of the pandemic, it spikes up. That's really the red line, not the bar. So you can see there's a massive spike up in the fiscal deficit. It crosses almost 9% of GDP. But ever since the pandemic year, we have been consistently reducing the fiscal deficit as a percentage of GDP. The government number for FY25 is 5.1%, and the expectation for FY26, because the government has already talked about this more than a year ago, is that eventually we want to get it down to 4.5%. at 4.5% debt to fiscal deficit, you will almost be back to where you were in pre-pandemic era. This is important because many countries which expanded fiscal deficit during the pandemic as a response to the pandemic have not compressed their fiscal deficit back to pre-pandemic trajectory. FY26, the target is 4.5%, and that brings us back to pre-pandemic trajectory. The bars indicate the size of the fiscal deficit, and you can see the absolute size has actually declined slightly in absolute terms. So this demonstrates the focus on fiscal deficit, particularly which we have seen in the last 5 years. On the next slide, you can see another element of the fiscal discipline of the government, which is to say that this is the breakup of government expenditure broken up into revenue expenditure and capital expenditure. And particularly look at the post-pandemic period, which is FY19 onwards, you will see that the yellow number starts to increase quite dramatically. You've gone from 13% of your expenditure being capital expenditure to almost 23% being capital expenditure. Now, government is not the largest player in the economy in terms of capital expenditure. It's actually the private corporate sector, followed by the households, and then followed by state governments, and finally the union government. So it is the smallest contributor, but to the extent possible, the government has certainly focused on trying to increase capex. Remember, they are doing this in a post-pandemic period. And again, I would say this is a very classic supply side response, which is to say, rather than put money in people's wallets, let's drive it to target the expenditure at things which will cause the economy to move faster and therefore actually has a more lasting benefit. There is no right or wrong in economics. Any policy that you choose will have certain desired effects, certain unintended consequences. Equally, if you follow the opposite policy, it will again have some desired effects and some unintended consequences. But what you can see here is a very clear focus during the post-pandemic period to say we will increase the focus on capital expenditure, which is a supply side strategy. Moving on from this, this is the inflation trajectory. FY16 is when inflation targeting comes into play. And I would say since 16 till today, we just got the latest CPI a few days ago, just around 4.7%. So in the range of 4% plus or minus 2%, I would say the Monetary Policy Committee has more or less done its job well, though there was a period in 21-22 where because of the base effect, inflation actually had gone well above 6%. But, largely over the last 8 years, they've been consistent in terms of holding it within the range. And of course, the governor increasingly talks about targeting 4%, rather than using the play of 4 plus or minus 2. This is a very significant change in Indian thought process, because if you look at previous decades, we've had high growth with high inflation, but now there is a focus on keeping inflation low and stable and growth more moderate, not necessarily looking at the highest possible growth, because we're also concerned about what is the level of inflation that is getting generated within the economy. So this provides a backdrop of what I talked about earlier, which is fiscal discipline and CPI control being some of the key pillars of economic management by the government over the last 10 years. Now, moving on to the next slide, I just wanted to paint the larger picture that if there is a reason to feel positive about the scope for economic growth in India, it is that corporates have benefited from the growth and profitability. The reduction in corporate tax rate also helped. There has been a massive profit boom in the last few years. You'll see that on one of the later slides. And as a result, corporate leverage, defined as corporate net debt to EBITDA, is come down to a record low number. This is the lowest going back to almost 20 years ago. So the corporate sector is healthy and in a position to invest aggressively if it so chooses to. So, when we talk about growth in India, I would say the corporate sector is very well placed, and that is what is reflected here. On the next slide, we also have a reflection of the health of the banking sector in India. This is also important because we know banks can be cyclical. There are periods in which NPAs are stable. There are periods in which they spike up, and then again periods in which they correct down. But the good good thing is that if you look at that left-hand side chart, banks' net non-performing assets as a percentage of their total balance sheet are extremely low. And this actually gives a lot of comfort because this means the banks are in good financial condition, the balance sheets are strong, which should give them the confidence and the risk-taking ability to lend when the need arises and when they feel comfortable. Similarly, the capital adequacy at this point of time for the banking sector is very comfortable. In fact, this is the highest capital adequacy ratios we have seen in almost 2 decades. Again, it talks to the strength of the balance sheet and their ability to provide credit if the economy so desires. So what we've talked about so far has been the fiscal discipline, the inflation control, and the fact that the enabling environment for growth remains intact. It has nothing to do with politics. It has nothing to do with who is the government. But moving on from this, to the next slide, I just wanted to highlight that, given that the government is back in place, but of course it is a slightly coalition government, compared to the previous election, it dropped some seats. So we are just talking here about what might change going ahead. In our view, fiscal discipline is something that this government has been quite determined about, and we do not see them significantly deviating from the path of fiscal discipline. 4.5% we think is the target for fiscal deficit, will be reiterated in the budget, which will be presented next month by Finance Minister Nirmala Sitharaman, and we expect them to continue with that target. Having said that, it is possible that hereafter they may not target very aggressive cuts in the fiscal deficit, but that's something I'll talk about in my final point. Again, inflation targeting, it is one of the successes, and I think this fiscal discipline platform and inflation targeting platform has now gotten sort of sunk into the thought process of how to manage the economy for macroeconomic stability, and that is likely to remain. The only point that I would say perhaps the government might have to be not a complete change in point of view, but they may have to calibrate their decisions more carefully, because so far in the last 5 years in particular, the focus has been entirely on supply side measures, not too much or very limited measures on the demand side. You could say, for example, that the announcement which was made actually in December, which is to provide free food grains to effectively 80 crore citizens of India, is a more demand-oriented policy, and obviously that costs almost 2 lakh crores a year. So in a sense, they did a big demand side decision in December, but given the election outcome, I do think that the government will now have to be slightly more calibrated. Rather than rely solely on supply side measures, they may have to also look at some demand side measures. Again, may not be direct transfers of money, but there are many areas which are already being talked about. So for example, in 2019, you remember they started transfer payments to the farm sector. That transfer payment is still fixed at 6,000 rupees per farming family. If you index it to inflation, that 6,000 could become a slightly larger number today. That could be one simple way to say, here is a way to transfer more money into the pockets of the farm sector. Second issue which could be raised is that real interest rates are very high. But again, rather than give a direct benefit to somebody, you could say agri credit, MSME credit, we will subsidize some part of their interest cost. So in some senses, it is a supply side measure, but at the same time, you're ensuring that there is a direct benefit accruing to them. The classic demand side measures are things like income tax cut in the GST rate, but GST rate cuts have now moved into the domain of the GST Council. I think those are harder to do unless you take a holistic view, and I don't think there is enough time for them to look at that. So I would rate things like a GST cut as low probability. Income tax cut, not impossible, but do keep in mind that, there are just a handful of people in India who pay income tax cut. So the benefit of the income tax cut goes to a limited number of people, whereas you could use strategies which combine demand side elements with supply side strategies to ensure that benefit flows into people's wallets more directly, and that could also help the economy. So what I do expect, and we will see perhaps some signs of that in the budget. In a way, the first decision by the cabinet, which was announced day before yesterday, was an increase in the size and target of the PM Awas Yojana scheme, which again has elements of demand side and elements of supply side, because when you're providing support to the disadvantaged sections of society to build housing, it is both taking care of their need as well as it is effectively putting money in their pockets for asset creation. So that is perhaps a sign of the kind of things you should expect slightly more, but I do not expect them to really deviate from the path of fiscal discipline. And keep in mind that if the economy in nominal terms continues growing at about 10% or 11%, then even if you hold your spending in a slightly lower fashion, anyway, your fiscal deficit over time in persistent terms will drop. So I expect a continuation of policy on the first two items, but maybe some differentiation when it comes to the supply side focus. Some elements of demand side will also require attention. So that's about, the perspective I wanted to provide on what I think have been the pillars of the last 10 years of the BJP government led by Prime Minister Modi, and where you might see some changes come through in the current version of the government led by Prime Minister Modi again. So we'll jump from here very quickly to just take a look at the equity markets and valuation. This just shows you the trend in EPS forecast. 18% expectation for March 25, 15% expectation for March 26. I don't have too much comments on this except to say we have seen 2 years of very strong margin expansion in India in 23 and 24. And when I look at the 25 and 26 numbers, profit growth in the forecast is growing faster than sales growth. That might be a little bit of a challenge, because what that would imply is further margin expansion. And I think it's not impossible, but it is not something that I would necessarily think as a very high probability. So moving on from this to my final slide. We talked about some of these issues. May consumer inflation at 4.75%. The RBI's forecast now for the whole of FY25 is 4.5% inflation. MPC remained in pause mode last week. But interestingly, now 2 members voted against the decision to hold rates unchanged. And if you think about why there is some growing, I would say, signs that few members of the Monetary Policy Committee are voting against the decision to keep rates unchanged, it is in the next line over there, which is to say, if you look at the policy rate at 6.5%, and the RBI forecast for consumer price inflation, which is 4.5%, that gap is almost 200 basis points. And in the past, in many policy debates and discussions, we have seen, RBI, parts of the RBI have talked about a comfort zone of more like 100 to 150 basis points of real rates rather than 200. What does this mean? We think the question of rate cuts is now when rather than if. It will not be a very deep rate cycle because remember, economy is growing quite well. RBI's forecast is 7.2% for March 25. But yes, this is what we think is a matter of when. 1 to 2 rate cuts over the next 9 months we think is quite likely. Valuations, I won't stress this. Nothing much has changed since we spoke over the last few months. Mid cap, small cap still trading at a premium to large caps. Therefore, what are we recommending? First, please have a staggered approach towards equities. Our bias is towards large cap. Why? Simply because relative valuations give us more comfort in the large cap space. Hybrid strategies such as balanced advantage, multi-asset, equity savings, which are dynamic in nature, become more attractive because you're automatically getting some asset allocation take place in your investment in these kind of schemes. Or you could even consider static schemes like the conservative hybrid for those who are very conservative and the aggressive hybrid for those who don't mind 65% equity allocation. In terms of beta opportunities, where are they in the current marketplace? We like the banking and financial services space. I talked about the strength of the banking balance sheets. Valuations also are not very demanding at this point of time. Healthcare, slightly defensive. Valuations no longer cheap, but it's a sort of play on high-end consumption, and we think some of that still has tailwinds. Innovation fund, slightly more risky, concentrated portfolio, companies that are trying to disrupt things but could also get disrupted. So by nature, the holdings are in companies are more volatile, but we think this is a theme which is likely to play out well and in strong fashion over the next 5 to 10 years. And investors could consider the SIP route over here. So that's about it from my side in terms of painting the big picture on economic policy, valuations, and preferred investment themes. I'll halt at this moment and hand over to Ajay Tyagi, our head of equity, and he's going to take you through a discussion on the UTI FlexiCap scheme, which is managed by him, and he's been managing it for a long time now. So he'll take you through the nuts and bolts of that strategy and how it's positioned. Ajay, over to you.
Yeah, thanks, Vetri. Thanks for the macro backdrop, and welcome everyone. I hope I'm audible because I'm facing some kind of a video issue here.
Yes, Ajay, you're audible. Please go ahead.
Okay, sure. So let's just move on to the next slide, Niranjan. We'll start by the quote of Charlie Munger, one of the, I would say partners of Warren Buffett and one of the most successful investors over the last many, many decades. And he had an important message for all long-term investors. And here's his quote: "Big money is not in either buying or selling, but in waiting." And, there are many strategies, there are many ways to actually create alpha in the market. UTI takes great pride in different strategies. I will go through towards the end very quickly, in terms of the different strategies that we have here on the equity side. But suffice to say that, each strategy would go through its periods of outperformance and underperformance. UTI FlexiCap is a strategy where we basically focus on buying solid businesses. And within these solid businesses, the ones which are expected to show strong growth over the coming at least a decade, if not more. But the most important facet of our strategy is to hold on to these businesses through, thick and thin, through different phases of the market, through phases where sometimes markets are actually chasing them. More importantly, when markets are actually not chasing them and are not being favorably disposed towards them. So that in nutshell has been the strategy of UTI FlexiCap. And in this context, I thought that these pearls of wisdom by Charlie Munger are very important for investors like us to keep remembering all the time. Yeah, next. Like I mentioned, these are the three great pillars. Simply put, we are trying to buy high quality businesses. Within this, we are looking at businesses which can continue to grow, possibly because of the under-penetration that they have in that particular product or service to which they are catering. And finally, buying them at sensible valuations, slowly increasing exposure in them, not going suddenly into them, slowly increasing exposure into them, so that we are able to catch the ups and downs of the markets and therefore able to capture the valuations along these ups and downs, and then patiently staying invested in them. Yeah. So let's actually look at some of the names that we are holding, and we have picked them up from our top 10. What's also interesting about all of these names that you see in front of you on this screen is that they've all been underperforming over the last 2 years and 3 years. In fact, I would say 3 years. But what's important for us as fund managers running this particular style is to look at their track record in terms of their revenue growth and profit growth. I think while it's important for us to also measure the performance of our portfolio, because that's how the market rates us, that's how our end investors rate us. And obviously there is a implied or implicit promise to our investors that we would generate alpha or we would give returns higher than the benchmark, and that's the reason why they're investing in us. But rather than focusing only on that, we focus predominantly on how the underlying businesses in our portfolio are doing. And if the constant message from these businesses is that they are actually tracking and performing as per our expectations, then we go back to how we started this presentation, which is that we just remain patient and hold on. So this is the scorecard of some of the top 10 names. You would resonate with all of these names. You would also realize that while they are great companies, but they haven't done well in the last 2-3 years, The reason we are holding on to them is what you see in terms of their revenue growth, profit growth, and their profitability as measured by return on capital employed. If you go to the next slide now, you would see that they've actually been poor performers. Let me start from the extreme right three columns. Their returns over the last 1 year, more than half of them are negative. Their returns over the last 3 years, for a few of them is negative, and for the others are predominantly single digit. But one of the reasons why they've not done well is the fact that their current valuations are significantly lower than their long-term valuations. Markets, for some reason, have derated these businesses, despite the fact that their earnings growth, their fundamental scorecard and their report card is seemingly fine, tracking in line with their last 5-year or 10-year trends, but their valuations have got derated. Most of them are trading at a valuation discount compared to their own 5-year and 10-year averages. Let's put this scorecard against a few companies that we don't own in the fund. Now, these are some of the large companies which have done very well. They are also a big source for our underperformance against the benchmark. We own nothing in any of these names that you see in front of you, although they are all reasonably big in the benchmark. If you look at their fundamental scorecard, this is their last 10-year profit growth and revenue growth. Not a great picture, I would say, across the board. Return on capital also for many of these players is not good, is in fact poor. But yes, the story also is, as shown in the next slide, that they've done fantastically well as far as their stock prices are concerned. Again, first starting with the rightmost three columns, look at their returns over a 1-year period. The average would be 3-digit, 100%. On a 3-year annualized basis as well, the returns are very, very solid, around 40 to 50%. But one of the key reasons for this massive outperformance is what you see in the middle, the one highlighted in yellow. All of these companies are trading at a significant premium to their last 5-year and 10-year averages. So we really have, two very stark kind of groups that we have showcased in the previous few slides. One, the ones which basically have got derated in the last 3 or 5 years. These companies actually continue to, come out with strong fundamental report cards. Their revenue growth and profitability remains as strong as ever. The other group is, which also is in a way, from a fundamental perspective, not too deviant from their long-term history. They have seen a cyclical upswing in earnings for sure, but the longer-term earnings trajectory is not something which has changed. The longer-term profitability has also not changed. What has significantly changed is their valuation compared to the last 10-year history or 5-year history. So, we would again, I would repeat, focus on what we wish to do in this fund. And we have always maintained that at UTI, we are managing different funds with different styles. What we want to ensure is that we don't deviate from that style just because we are underperforming, and sometimes we do underperform massively, which is what we've been witnessing in UTI FlexiCap over the last couple of years. But so long as we remain convinced about what we are holding in the portfolio, and so long as the numbers that are being reported by these companies support our conviction, we really have nothing to do here. In fact, double down and stay invested in these businesses. As Charlie Munger said, we just have to wait, because sometimes the big money is in waiting. Yeah. The other thing that we practice in our strategy is to continue thinking about the long term, not being tactical or opportunistic, thinking about at least the next 5 years and 10 years, and on that basis do our stock selection. And like Warren Buffett has said, by thinking and staying invested over the long run and lengthening the time that you stay with a good quality business, you can create wealth that you would have never imagined. We all know the power of compounding, but believe me, the power of compounding works wonders with a great business, and it actually doesn't work too well if you actually buy a business which is weak, poor, not so great. And the next slide basically shows you just that. We've taken 6 companies. All 6 of them are solid names. Asian Paints, HDFC, and Nestle are in one camp. In the other camp are State Bank of India, Tata Steel, Tata Motors. All six are great companies. The bottom three have done particularly well over the last 3 or 5 years, have been very strong in terms of their stock performance, in terms of their business performance also have been very strong. But if you look at this entire equation from a longer term perspective, you would realize that while different companies would go through their own ups and downs, they will have their own phases of their stock prices either doing well or not doing so well. Ultimately, in the fullness of time, over longer time periods, 10 years, 20 years, and beyond, their stock prices eventually will be a function of how their businesses are, how strong their businesses are. The top three, obviously, as many of you would acknowledge, are much stronger than the bottom three businesses in terms of profitability, in terms of return on capital, return on equity, return on assets in case of banks. And therefore, there is a marked difference between the returns given by these two different sets of businesses. While a difference between 20% and 15% may not appear to be too large when we talk about annualized numbers, but over a 30-year period, it can be actually very stark. For instance, Asian Paints has grown 1140 times over the last 30 years compared to a Tata Motors or Tata Steel of around 35 or 38 times. So yes, every company, every business can go through a period of very strong stock performance or underperformance, and these periods can last sometimes 2 years, 3 years, sometimes even more, even 4 years. But the ultimate test is whether the business is really profitable, scalable, can it continue to compound at healthy growth rates? And if the answer is yes, then holding on to these businesses does actually lead to wealth that you and I could have never imagined. Yeah, next. Now, this is another way of representing whether it's important to also time these high quality businesses, because more often than not, people say that these could be growth at any price businesses. They went up too sharply in 2020 and 21, and I would not deny that fact. I think, yes, the valuations did go overboard during that period, just like at this juncture, the valuations have gone overboard for many other parts of the market. We showed in the previous slide how many of these large companies also are trading at significant premium to the last 10-year averages. So yes, in every phase of the market, something may be going up, something may be coming down. But the fact here is that if you indeed have selected the right business and you have the ability and the fortitude to hold on to it for long, then timing does not matter that much. Yes, it does matter from a 2-year or a 3-year perspective. Surely it does. So we're not saying that you buy them at any price. But what we're trying to say is that for these businesses, you buy them at the right price, but more importantly, they create wealth for you because you continue holding on to them for very long. And the simple exercise we have done here is, we have, for all of these companies, and these are all part of our portfolio, for all of these companies, we basically said that there could be 2 modes of investment. Number 1 mode is the simple SIP mode. So you make an investment of rupees 1 lakh every year on 1st of Jan. You do it for 10 years. So this is a simple SIP that you and I do in a mutual fund scheme without bothering about the price. We just invest 1 lakh rupees every 1st of Jan. After 10 years, this number grows to, for instance, let me stick with Ajanta Pharma, the first stock up there. After 10 years, this number grows to 62.68 lakhs. The second model is where somebody is very conscious about valuations, where the underlying thought process is that, look, these are great businesses, but they also must be bought only at the right valuation. Never a bad thing to do. And here, what we have done is, with the benefit of hindsight, we have basically picked up the lowest point for that particular stock. For instance, since we are on Ajanta Pharma, the lowest point at which Ajanta Pharma has traded in each of these previous 10 years, and we have made that 1 lakh rupee investment only on that particular day. The result is that after investing at the lowest point of the year for 10 years consecutively, this amount grows to 67.68 lakhs. On an absolute basis, this is a difference of 8%. Mind you, over the last 10 years, 7 out of these 10 years, Ajanta Pharma was down more than 20% in each of these years. So therefore, it's not as if the stock has been very stable. In fact, In 7 out of 10 years, the stock was down 20% from the high point, and we made this 1 lakh investment only at this point. Yet the difference is not too stark when you compare an SIP return versus investing at the lowest point return. And the point here, once again, is that wealth is created by these businesses on account of the ability of these businesses to generate cash flows and then reinvest their cash flows for a fairly long period of time because of the kind of strong growth that they are witnessing. Yes, valuations do make a difference for over a 1 year, 2 year, 3 year perspective. Do they make a difference over a 10-year perspective? The answer is not a whole lot. I won't repeat each of these names mentioned on the table, but as you can see, if we take an average of all of these names, the average comes out to be, simple average comes out to be 11%. So therefore, I would say that rather than only focusing on valuations, what we are trying to do in UTI FlexiCap as part of our strategy is to focus on the strength of the business and not focus as much on the valuation of the business, which is something which some of our other strategies are practicing very, very successfully. But here, once again, I want to repeat that we may have seen a phase of poor stock price performance for companies in our portfolio, but they are indeed high quality, high growth. We wish to remain patient with them. Their intrinsic compounding is happening every day, every month, every year, and that is what is more important for us. Yeah, next. This is in terms of the overall portfolio, the scorecard. And the scorecard, as you can see, very clearly demonstrates that there is no let off in terms of the core fundamental attributes of our portfolio. It remains strong in terms of revenue growth. Revenue growth continues to be in high teens. In fact, in the last 3 years, it's actually higher than the last 5 years and 7 years at 19%, higher than the benchmark very clearly. The operating profit growth also continues to be in the same trend line, around the same trend, which is about 17, 18%. No let off as far as, that is concerned. Return on capital remains approximately 10% higher than the benchmark. Again, no change in that. Net debt to equity remains negative, which basically means that our companies are net cash rather than net debt. So the fundamental attributes for the companies that we are holding, as demonstrated in this aggregate measure for the full portfolio, is very solid, remains to be solid, and we expect this to continue remaining around the same ballpark in the coming years as well. Yeah. This is the full portfolio. Maybe we can, if you have any questions around the portfolio or any of its holdings, we can address that later. But to move on to the next chart, this is basically, on the right-hand side, our sectoral breakup. Where are we bullish? Where are we bearish? On the left-hand side are some of our big active positions. Let me start with the left-hand side. So some of our large active positions are in LTI Mindtree, Bajaj Finance, Avenue Supermarts, Info Edge, and Astral. The stocks where we are underweight, and in fact we are zero, are Reliance, L&T, ITC, TCS, and Axis Bank. One of the other things that you will see in our portfolio is that we have a very high active share, which means that we can be highly divergent from the benchmark, which obviously leads to divergence in performance also, both versus the benchmark as well as the peer set, for the simple reason that we are following a bottom-up strategy. We're not looking at the benchmark, trying to reduce the tracking error in performance by staying close to the benchmark. On the contrary, we are basically looking at companies which can maximize wealth without taking any undue risks and holding on to them. And that does lead to phases of sharp outperformance, but then equally sharp underperformance as well. So long as we feel that over a full cycle, these businesses will do much better than the constituents of the benchmark, we would actually do well to stick to this rather than make any changes in this just to reduce performance deviation. Yeah. The right hand side is our sectors where we are positive or negative. We remain positive on financial services, consumption opportunity, both across staples, discretionary, durables, and services. Is something which is an overweight for us. I'm sorry, staples is the only one which is underweight, but all other parts of the consumption piece, durables, discretionary, and services remains overweight for us. We're also overweight on healthcare, significantly so, mildly overweight on IT, But then there are a lot of sectors where we are underweight. Many of them have hurt us as well, but we are underweight on them simply because that we are unable to find companies which possess the kind of economic characteristics that we wish to see in our companies before we invest in them. Yeah. So I think that was about it. I'll hand over back to Niranjan to lead us into Q&A.
Yes, sure. Thanks a lot, Ajay, for such a clear deliberation on the strategy UTI FlexiCap Fund. Now we will, of course, move on to take a few questions in the next 15 minutes or so. So viewers, just a request, keep punching in your questions in the comment box. So we will try to take as many as possible in the next 15 minutes. So Ajay, here is the first question. So our UTI Score Alpha strategy, so which is actually well known for its diverse approach for portfolio construction, right? So using this, how could actually investors use this particular approach for portfolio construction over a period of medium to long term in their portfolios? If you can just explain.
Sure. So I think what Score Alpha does is it basically binds the entire team in a way to focus on two very important fundamental attributes. One, cash flow generation of a business. The other is return on capital of a business. Now, on this spectrum, we basically have our different strategies positioned at different parts of the spectrum, at the extreme ends, of course, and also in the middle of the spectrum. What is something which is non-compromising for us is the ability of companies to at least generate strong operating cash flows, because if they're not even doing that, then why are they existing in the first place? But when we look at companies which are generating operating cash flows, we define the spectrum in ways that different strategies can reside into different pockets of this spectrum. And this is what this table in front of you shows. Let me start again with UTI FlexiCap, a fund which basically focuses on the one extreme of the spectrum, basically companies with very high return on capital, very high cash flows. This is what I basically explained over the last 15 minutes. And as a consequence, it will always be expensive. Just look at the premium at which it trades to the benchmark. On a price to book value perspective, it trades at a 53% premium. Let me automatically now come to the other end of the spectrum, UTI Large and Mid, a fund which has done exceedingly well in the last 3 years. And if you look at the basic tenets of this fund, this is a fund which will actually be investing into companies which may not be very strong in terms of return on capital, but basically do have a fairly good business model, a fairly stable business model, and are trading extremely cheap today. And this could be on account of a few challenges that the business may be facing at a particular point of time, because of which the valuations could be cheap. It could also be that these challenges are leading to the return on capital metric to be lower than their average 5-year, 10-year trend numbers. But this is what gets captured in a typical value style strategy, which is what UTI Large and Mid Fund is all about. And as a result, the price to book value is at a 52% discount to the benchmark. So these are the two extremes, along our spectrum, and that spectrum basically is getting created using our Score Alpha. What you see in the middle are basically strategies which are neatly positioned at different points along the spectrum, some being a blend style like UTI Focused Fund and UTI Large Cap Fund, which hardly have any premium compared to the benchmark, and some, like I mentioned, operating at the extremes. Yeah.
Sure. Thanks, Ajay. So, there is a question to you. India's elections have actually brought broad policy continuity and likely to prioritize infrastructure capex and improvements to business environment, right? So, however, what are the risks of this coalition government, particularly if they go strong on populist measures?
Yeah, so I don't want to answer that in detail because I think we already covered that in the opening slides, except to say that, the focus of the last 10 years was a lot towards supply side. I think at the margin, they will now have to include some elements of demand side as well into the policy mix. I don't see a change in the fiscal deficit targets, but I do expect that if you have experienced a loss in the number of seats from parliament, and we know that there is enough economic data and evidence that certain segments of the population have not fully recovered the kind of income mobility that they had pre-pandemic, then there is certainly a very strong case to be made for some intervention over there. So I don't read this as coalition politics or anything to do with coalition. It is a question of a government responding to what is the need of the people and what have they signaled. But I don't expect a major deviation from fiscal deficit and from inflation targeting. But structure of expenditure continuously moving towards capex, I think some of that could certainly halt, and some demand side measures are most probably necessary. And that is where I believe the government may interpret. This is only my view. I could be completely wrong.
Ajay, the equity markets over the last few years have rewarded businesses that tend to have high cyclicality over the businesses with strong earnings growth potential. So, do you see the trend reversal anytime soon?
Well, that's $1 million question, Niranjan. I wish I had an answer. I don't. But you see, the beauty about being an investor in the markets is that you may never know what's going to happen in the next 3 months or 6 months. But as history would teach us, you would be able to make a fair bit of conjecture in terms of how deep that existing trend has been and whether the trend will continue for long or maybe is up for reversal. So while the timing may not be known, but at what point of time, at what stage are you within that particular trend or within that particular cycle is something which can be learned using historical charts and data. So this particular chart is about the quality performance versus the value performance as represented by the two indices which have been in existence since 2005. And simply put, the blue shaded areas are the phases of quality performance. The yellow shaded areas are the pockets of value outperformance. Your question was about cyclicals. We use this term value interchangeably with cyclicals. Of course, it may not be a pure one-on-one overlap, but yes, when cyclical businesses do well, typically the value part of the market does well. And as you can see on the extreme right, we've seen a prolonged phase of such kind of companies doing exceedingly well. In the past, since 2005, whenever these phases have happened, they usually have reversed, sometimes in 12 months, sometimes in 18 months, sometimes they've even gone beyond 2 years. This time certainly is a period where the cyclicals or the value part of the market have outperformed for almost 3 years running now, slightly over 3 years running now. So is it up for reversal tomorrow? Who knows? Can it persist for another 6 months? Maybe yes. But at some stage, and maybe not too far away, you could see a reversal. This is what this pattern is telling you. Yeah. I think we also have one more chart, Niranjan. In case we have time, I can spend a couple of minutes on that one, which is about, again, using the quality and value indices to figure out where are we in this trend, is the trend up for reversal, and so on. Now, just bear with me for a minute so that I can explain these two lines that you see. Let's focus on the blue line first. Simply put, this blue line is the difference between the quality index and the value index on a 5-year rolling basis. Again, to just make the chart even easier to understand, let me just say that whenever the blue line touches the upper part of the chart, that's a phase which can be termed as a phase of very strong quality outperformance versus value. And whenever this blue line touches the bottom of the chart, and we can see that the blue line has touched the bottom x-axis thrice in the last 15 years, and all three of these time periods are circled in red. If you can see, these are phases of quality underperforming value on a 5-year rolling basis. Each data point here is 5-year rolling. So whether it touches the top or the bottom, the top is massive outperformance on 5-year rolling basis of quality against value. The bottom is underperformance, significant underperformance of quality versus value, again on a 5-year rolling basis. It's happened 3 times in the past. And whenever it's reached to this extreme, what has happened in the next 1 year or next 3 years is basically reversion to mean. And as you can see here, after touching the bottom, let's say we are talking about August 2017 here, after touching the bottom, the orange line, which is the next 1 year return, or I should say the next 1 year performance of quality versus value, is a positive 40%. So underperformance over the previous few years and reaching to a level which is an extreme, and an extreme is defined as the blue line touching the bottom, usually leads to reversion to mean in the following year. And in both in 2010 and 2017, it had reached to a number higher than 25%. The next chart is the same philosophy or the same thought process, but with a prospective return of 3 years instead of just 1 year. I think the chart is taking some time to come up. Yeah. So the blue line remains exactly the same that we saw in the previous chart, but the red line now is prospective 3-year returns. I'll again, explain using August 2017 an example. This was a phase where quality underperformed value significantly on a 5-year basis, but holding on to quality did lead to a strong outperformance in the future. The red line shows that over a 3-year period, quality outperformed value by 30%. Now, the interesting bit before we wrap up this slide, the interesting bit is that you can use this chart on either direction. In 2020 and 21, when quality was massively outperforming, and therefore it had touched the upper end of the chart, what happened over the next 3 years was quality underperforming value by 30% per annum. So yes, this chart does capture the extremes very well. And we can never say, what is it suggesting in terms of the exact timing of reversal. But yes, it does tell you what the direction should be expected over the next 1 year or over the next 3 years. Yes.
Yeah, sure. Thanks, Ajay. So in the interest of time, we will take last 2 questions for this evening. So this is a question to you, Vetri. So which is on the US-Saudi Arabia petrodollar deal. Which is a pivotal arrangement in the global finance, right? So, and this has actually ended very recently after 80 years. So, therefore, is it likely to, will it actually lead to the use of alternate currencies for the international trade to pick up? And also, would this potentially weaken the US dollar global dominance and also changing the global financial dominance dynamics?
Vetri, you're on mute.
Yeah.
Many questions there, but very quickly to cut to the chase. The dollar still dominates the payment system. It is the most liquid currency. And if you are worried about political risk, then really one of the last currencies you want to go to is the yuan, right? Because many large dominant trading partners in the world would say that is not a currency to which they want to have exposure. So China may try to increase its share of trade with other partner countries where there is both a demand and supply for each other's products towards the yuan. But I don't think it really changes the global architecture of payments, because there are too many large countries in the world, including India, for example, who don't wish to get exposed economically to the Chinese yuan. So I think it's still very premature. We don't have a good alternate to the dollar. That is the harsh reality. And right now, the dollar is super strong because of their economic growth being so high and rates being held up. So I think it's a while before we can call, end to dollar strength. Longer term, if you ask me, the biggest concern we should have about the dollar is the lack of responsible economic policies in the US, both on the fiscal side and the monetary side. And unfortunately, right now, it looks like the 2 main political parties in the US both subscribe to the same level of irresponsible fiscal and monetary policy. I think that is sowing the seeds of an eventual decline in the dollar. But, maybe not just yet. I'm not calling a turning point right now.
Sure. Thanks, Vetri. Ajay, this is a question to you. So the pivot to interest rate cut seems other than expectation, right? So as the central banks in India as well as US are not in hurry to cut the rates as they're not fully convinced with the decline in inflation and growth pressures. So how is this going to impact the businesses which are less dependent on the external funds and also the ones which are debt heavy?
So, see, that's very straightforward, Niranjan. The businesses which are not dependent on external sources of funding have nothing to lose here. Obviously, they are funding their growth using their own internal cash flow. So, high interest rates or high cost of money doesn't impact them. There is a second order impact, though. Many of these businesses, which are high growth in nature, trade at high valuations. Interest rates remaining high theoretically is never good news for these businesses from their price or valuation perspective. It doesn't make any difference to them on the fundamental perspective in terms of how they operate, in terms of how their balance sheet would behave, in terms of their return on capital. Nothing changes as far as those fundamental attributes are concerned. Interest rates remaining high for such high growth businesses does have an impact on their valuation. So that's the only point. The bigger evil obviously is for companies which are dependent on external sources of funding, which have high debt. And I think interest rates getting cut at some stage is a given. It may get cut as recent as September or December of this year, certainly next year. But the more important thing for all of us to acknowledge here is that interest rates are not going back to where they were pre 2020. Interest rates, if you talk about the Fed fund rate, may actually bottom out at 250 basis point or somewhere in that range. So we're not going all the way back to 25 basis, 50 basis, and so on, which means that if cost of money remains relatively high compared to the average of the last decade, there would be consequences for many leveraged businesses well into the future, into the mid to long term. If liquidity is not as abundant, because Fed had a very relaxed balance sheet or an easy balance sheet in the last decade, that also means that fundraising may not be so easy as well. So, yeah, I mean, fundamentally speaking, this is not good news for leveraged businesses, for businesses which constantly are in need of capital. But yes, like I said, there is a nuance in terms of the second order impact on valuation. Yeah.
Ajay, if you allow me, can we take one last question?
Yeah, sure.
Sure. So there's a question again on the FlexiCap strategy. So the premium in terms of the price to book on in case of the FlexiCap fund vis-a-vis the benchmark is more than 50%. So how do you actually look at this expensive valuation? And do you think this such a high price to book or the price to earnings is justifiable compared to the other names? So if you can throw some light there.
Sure. See, that's a important question for us to address. And the answer is that, look, valuations are not a very subjective thing, essentially. We may talk about valuation in terms of this is 40 times and maybe some other business is 20 times and something is trading at even higher 50 times. But all of these are essentially linked to the fundamental attributes of a business. And there are two key attributes which eventually decide the valuation of any stock. And these two key attributes are return on capital and the sustainability of growth. If growth will continue to remain high, and here let me just give you an example of a company like Asian Paints, for instance, versus a company like NTPC over 30 years. Asian Paints would have shown a growth of around 17-18% over the last 2 decades. NTPC would have shown a growth of around 9-10% over the last 2 decades. Asian Paints would have delivered a return on capital of around 35-40%. NTPC would have returned a return on capital of barely 10-11%. Somebody can look at these numbers, and somebody, I would say, would have looked at these numbers in 2010, 2000, 1995 and said, why do I pay just 1.5 to 2 times price to book for NTPC? And why do I, pay about 7 to 8 times price to book for Asian Paints? The answer lies in what I just explained. Materially higher growth and the compounding difference or the impact of compounding between a 17% growth and 10% growth cannot be calculated by the human mind so easily. You have to go back into history and see how much of a big difference did this growth create. The second thing is your capital efficiency, 30% versus 10-11%. So I think that is what determines price to book value. What we have to do in FlexiCap is to be sure that if we are giving a high multiple to something, it will indeed persist in its higher growth and higher profitability. If we have got it wrong from that perspective, then we will lose money. If we have got it right from that perspective, our stocks may or may not perform for a year or 2 years, but we will eventually end up making strong returns by patiently staying invested in such kinds of businesses. Yeah.
Sure. Thanks, Ajay. So with that, I think we have reached towards the end of this webinar. So thanks to you and of course, Vetri as well, and viewers for their participation and for their questions and making it more interactive today. So just a request to the participants, please use the feedback link, which is also available on the screen, to share your feedback on the topics that we covered today and also webinar in general. So that will always help us to engage better with you in our future webinars. So with that, thanks everyone for joining us, and good evening.
Thank you.
Thank you, everybody. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.